expected held interest rates at 5.25%. The key thing that we're looking for is the split in the votes. In 13th of December, the MPC's last vote, it was 6-3. In other words, there were 3 members of the MPC who wanted to raise interest rates further. We're expecting we won't get that composition this time round. I'm just desperately looking to see if we've got it right. The vote was, this is an interesting one, Jane. It was a 3-way split. 6 members of the MPC voted to keep bank rate unchanged at 5.25%. 2 of them voted for a hike. 1 of them voted for a cut. That's actually slightly more hawkish than we were anticipating. The market consensus was that we would get an 8-1 vote or even a 9-0 vote in favour of keeping rates unchanged. That is absolutely fascinating. I'm just looking to see what more data I can have. It's the first 3-way split since 2008. The bank has also changed its forecasts. The bank now expects, and this is again very interesting, Jane, the bank was saying, and only as recently as last November, it did not expect its inflation target to come down to its inflation to hit its 2% target until next year. Well, the bank is now saying it expects inflation to hit its 2% target in April. But the governor has said he expects to see more. He needs to see more evidence of lower inflation before the bank can start cutting rates. The bank has upgraded its economic forecast, but is warning of a near 50-50 chance of a technical recession in late 2023. So that is pretty meaningful. The bank has adjusted its expectations on inflation pretty significantly. As I say, they weren't expecting inflation to hit its 2% target until next year. It now says it will hit that target by April. That will really raise expectations that the bank is ready to start cutting interest rates fairly shortly. But I would draw your attention to that 3-way split. That's the chart that we can see. The bank raised bank rates 14 times between December 2021 and August of last year. We haven't had any changes since then, which is pretty significant. But nonetheless, it is very interesting that you had 2 members of the MPC voting this week to tighten monetary policy further, to raise interest rates again. Why would they do that, you might ask, given that the trajectory for inflation is on the low side? Well, it's because they're looking at not just the headline rate of inflation, CPI, they're also looking at services inflation, which is running significantly ahead of that, and also core inflation, which is the measure that strips out volatile elements such as energy, food, drink, alcohol and tobacco. It's also worth pointing out that it was actually tobacco that caused that rise in inflation that we saw in December. Inflation rising from 3.9% in November to 4% last month. That was entirely, more or less, because the Chancellor Jeremy Hunt raised tobacco duty in his autumn statement, and that pushed up the price of tobacco, and that fed through to a higher headline rate of inflation. We're also expecting another uptick in inflation this month in January, and that's due to what economists call base effects, the year-on-year comparison. And inflation in energy prices is actually slightly ahead of where it was in January last year, and that's why we expect to get another uptick for January. But nonetheless, I think that's a very significant change from the Bank of England's outlook indeed on inflation. It really will raise hopes that the bank will start cutting interest rates sooner rather than later. Don't forget, of course, the market is pricing in cuts in interest rates this year to take bank rate from the current 5.25% to around 4.75% or even 4.5% by the end of the year. That will be tonic to a lot of homeowners, of course, because bear in mind, Jane, that there are still something like 1 million homeowners who have to roll off their existing fixed rate and move on to a new fixed rate at some point this year. And those interest payments will only be going up. So a little bit of tonic potentially for homeowners there. I suspect the read across from that would be that if you are coming off a fixed rate deal in the near term, it might be worth going for a short-term floating rate, because there will be lower fixed rate terms coming down the line if, as expected, the Monetary Policy Committee cuts interest rates in response to falling inflation. Interesting to note, though, those comments, Jane, from Andrew Bailey, the Bank of England governor there, clearly trying to temper expectations of an early interest rate cut. They're saying that the bank needs to see more evidence of a sustained fall in inflation before he can actually move on that, before the monetary policy can move on that. I'm just trying to look to see what the pound has done on this, Jane. I mean, sterling has sold off overnight on the back of the US Federal Reserve's decision last night. It hinted against an early interest rate cut. A lot of people thought the Federal Reserve might go for a rate cut in March of this year. They didn't deliver on that, and they talked people down from expecting that. I can tell you sterling looks at the moment to have rallied slightly on the foreign exchange. It was off, it's off only by 1/5 of 1% right now against the US dollar. It was off by nearly 1/2 of 1% earlier on. So sterling rallying on foreign exchange markets against both the euro and the dollar. I think that reflects the fact that unexpectedly you had two members of the Monetary Policy Committee voting in favour of a rate hike this time around. One of those, I imagine, would have been Catherine Mann, the main hawk on the Monetary Policy Committee. But as I say, very interesting to note that you had another member voting for a rate reduction. That would have been Swati Dhingra, who is the main dove on the Monetary Policy Committee. So the headline, rates are unchanged, but the bank expects inflation to hit its target of 2% by April this year.